So actually, this is the tweet that Max Kaiser quoted and was actually cited in a Forbes article talking about the
Let's
death debt
go.
spiral. So what's happening here is I just wanted to draw a simple line of what the conclusion of what the Fed is doing right now. Because even today, you heard the governors come out and a couple of presidents come out and say what's happening is that rates are going to stay higher for longer because their idea is that higher rates is going to fight off inflation. And without going into too much detail, let me say it this way. They would be correct if, and here's the big if the United States wasn't $36 trillion in debt, or I think it's 34, it's getting up there pretty close. It's growing fast. It's hard to keep track of. It's growing so fast, but we're $34 trillion in debt. We have $211 trillion of unfunded liabilities, which means that we have a problem because we're not earning money. You and I, we go to work, we earn money, and then we spend less money than we earn. And whatever is left over, we can save or we can invest depending on what the marketplace is incentivizing us to do. Well, the government doesn't work that way. They collect roughly $4 trillion in taxes, and then they claim to be spending 6 or $7 trillion. We're finding out now it's probably closer to $8 and $9 trillion that they're spending. So we're running what's called a budget deficit. We're spending more money than we're earning. And that creates a debt problem. And that's why we have the big debt and the unfunded liabilities. But here's the real issue. In order to continue to fund those liabilities, or in other words, in order for people to still receive their Social Security, in order for people to still receive different government benefits and programs and payouts, that money needs to be borrowed. And when they borrow that money at a higher interest rate, that raises the deficit. And that the raising of the deficit requires more borrowing, which is issuing of more treasuries, which forces the yields higher. And you get stuck in this kind of cycle where you can't really escape it. And that's what my tweets have been about. And I think people are really starting to wake up to it. And that's why we see the 26, $27 trillion bond market with more volatility than the stock market, more volatility than Bitcoin. How's that possible? I thought Bitcoin was dangerous because it's volatile. The bond market is supposed to be the most stable market in the world, and it's become the most volatile market in the world. And the reason is because the government is stuck in a situation where they're spending more money than they're collecting. And that's the dilution of the dollar. That is a definition of inflation. They're collecting the dollars, they're borrowing the dollars, and they're spending them into circulation. And that increases the overall amount of circulating dollars in the country and in the world, even. And that creates the inflation. And this kind of death spiral, the debt spiral is what Forbes called it, is almost impossible to escape. And that's what some of my newer tweets were about, where right now in a traditional market, like think about it like this. We're all lenders, right? So when we go to the bank, we actually don't deposit our money with them. We lend our money to them. And that's why they pay us interest. Now, what the bank did was they took the money that we gave them and they went and they bought a corresponding asset on their balance sheet. So they don't just take our dollar and hold it. They take that dollar and they invest it. And the goal is to generate a yield with that investment that's larger than the amount of interest they promised to pay us for the original deposit lending. And they arbitrage, I call it custodial arbitrage. They arbitrage the difference between what they have to pay to their depositors and what they can earn in yield in the background. Well, when the Federal Reserve lowered rates in 2008 all the way down to zero, something happened. The banks had to, in order to earn interest, go out the yield curve. They had to go to the longer expirations. They couldn't just buy the 3-month or the 6-month or the 2-year. They had to move out the yield curve in order to actually make a profit. So they've got bumped out into the note and to the bonds. And remember, there's 3 types of treasuries. You have a treasury bill, which expires in less than a year. You have a treasury note, which is 2 to 10 years. And you have a bond, which is 20 plus. So they got pushed out from the bills, which had the least amount of time duration risk, all the way out to the end of the curve into the bonds. And they had to, because the Fed stated the front end of the curve down to zero. So if their depositors, if you remember, at one point when your money in the bank, it would get in 0.1% or 0.01%. Why? Well, because the banks were having a hard time getting anything at all. So they can't pay you more than they're making. They'll go out of business. And that process of getting pushed out the yield curve is why they got stuck, because now when the Fed had to raise interest rates to fight inflation, it diluted the value of the collateral. And the collateral was the government debt that was supposed to be producing the yield, which was producing the profit, because the yield was greater than the amount of profit sharing they were doing with their depositors. That whole system is breaking down right now. And I said that when I was back on your show back in March. These guys are breaking the system by raising interest rates because they're devaluing the collateral of the system. When they raise the interest rate, the yield goes up, but the price goes down. So, for anybody who borrows against Bitcoin, if let's just say Bitcoin was worth $100,000 and you borrow $70,000 against it. Well, if the price of Bitcoin goes down, the leverage of your position increases, the loan to value percentage increases. And if it goes down from 100,000 to 70,000, the person who is holding that collateral is going to say, well, I don't trust CJ to pay me back $70,000. I have to sell. I have to liquidate that $70,000 of Bitcoin in order to make sure that I don't lose money on this transaction, because he came to me with $70,000. He hasn't paid it back to me yet, but now the value of this collateral is $70,000. I better sell it and lock in my 70,000 and make sure I don't lose any money here. Well, that's not a situation that you really want to be in as a borrower or a lender, because there's liquidation risk and you might not recover the full $70,000. There's exchange fees. There might be some slippage in there with a bigger position. So you could actually end up losing money. The treasury collateral is losing value every time they raise the interest rates. Of course, we all know they did the most aggressive interest rate hike in the recorded history. The amount of percentage of growth in the rate is unmatched through previous raises. And they devalued the collateral just as fast as they raised the interest rates. And kind of just to tie this back into Bitcoin, I want people to think of, because remember last time I was here, I said Bitcoin is transforming from digital gold to digital collateral. Well, look, treasury collateral did so well as collateral because the Fed forced rates to stay even. So the principal value of that collateral stayed pretty steady. But over time, it's now deteriorating. And that's because of the amount of inflation that they created through deficit spending. But imagine Bitcoin as the world's most pristine form of collateral, the reserve asset of the internet economy, a deflationary money that gains value over time. They had to state the rate of bonds and treasuries lower so that the value would stay stable, so that it could support the system. And Bitcoin would actually be a collateral where you can't state the rate because it's an open free market. Matter of fact, it's the only free market interest rate in the world. Every single country, every single leader, every single central bank, they try to state the price of money. Only in the internet economy is the interest rate based on the supply of money and the demand for loans. When the supply of money is high and the demand for loans is low, interest rates go down. When the supply of money is low and demand for loans are high, interest rates go up. It's a free market price discovery mechanism, the same way it really should work in the traditional system, but it doesn't. And that's an advantage for Bitcoin. So not only do we have free market price of money or free market interest rates and free market price discovery, we also have a new collateral, the most pristine form of collateral in the world, that's deflationary and gains value over time. That way, over time, as it's acting as collateral, the amount of leverage actually decreases. If you're borrowing against it, your loan to value goes down. You're more safe, right? Just like if they stated treasury rates from today from 5.25 to 5.5 target all the way down to zero, well, then the market price value of the collateral will go back up. It would actually make the system more stable and more secure. Of course, there's trade-offs with that, because when rates go down, helicopter money, funny money, lots of extra borrowing is going to take place. And all of that information is really wrapped up into that tweet. the process of the marketplace incentives, the value of the collateral, the rate at which the collateral is being devalued through this uh, interest rate hiking process that we're going through right now. All of that comes together and creates the debt death spiral. And we're stuck in it right now. There is nothing that the Federal Reserve can actually do. And that was one of my most recent tweets. You have to, when you read my tweet, you have to come to one of two conclusions. One, I'm a complete idiot and I have no idea what I'm talking about. Or two, you better listen to what this person's saying because something's happening right now that's never happened before in the history of finance. And unfortunately, I wish I was an idiot, but I'm not. And we are seeing, for the first time in the history of finance, the sovereign debt market exploding because of those levels of debt. You would think if the Federal Reserve could raise interest rates and attract more people to borrow treasuries, then that would be the natural process of attracting demand. But what the smarter market is figuring out, what the smart money, dumb money is buying bonds right now. Dumb money is betting on TLT. I'm sure you have the tweet, Opti, but 21 billion in 2023 alone going into BlackRock's TLT, long dated treasury fund. Everybody and their mother, it's like the common trade, right? It's like when Bitcoin was $69,000, $70,000, you go to the grocery store and someone's like, hey, have you heard about Bitcoin? It's like, whoa, maybe I should think about selling a little bit here, buying some real world assets, because who knows what's going to happen when everybody's talking about it, right? But then after the FTX crash, you're telling people, hey, it's a great time to buy some Bitcoin here. They're laughing at you. So the mainstream sentiment is usually off. Mainstream sentiment is wrong. And right there on that chart, that is what the mainstream is hoping and praying for. The mainstream is hoping and praying that we get some kind of head and shoulder design here where the yields maybe they bounce back up a little bit, but ultimately they break this trend. You see this trend that we have here going all the way since back May? This is very aggressive selling. This might look like price is going up, but this isn't price. This is actually yield. So it's inverse. The price is going down. These are the yields going up. Everybody hopes that these yields break this trend and come back down to 4% and then break down even lower. And the reason is because they're the ones who are buying the notes and the bonds. This is actually the 10-year, so this would be a note. They're the ones buying it, piling in, hoping that they're going to get a capital gain. But what they don't realize is as they pile into this, they're actually just looking at the face value of the opportunity, which is, hey, it's 4%, it's 5%, I can't go wrong. But you have to be able to sit here and say, I can't take this at face value. If my bank is offering me a CD at 5.25%, or I have an investment opportunity at 6% or 7%, you have to calculate the real rate of return. The real rate of return. And before I dive into real rate of return, let me just address this chart one more time, because I find it extremely interesting that we had these big buyers step in. And if you update this chart today, there was a little bit of a bounce, but we're still above that 4-5 level. But you'll notice the candles, they were about to cross that yellow line. Well, that yellow line is the 2-year note yield. So the 10-year and the 2-year were about to uninvert. And the green line is the 3-month bill. That's the shortest duration available to the public. You'd have to have a master account with the Fed to access the repo market, or give your money to a money market fund in order to get a better deal than the 3-month. It's the best short-term duration with the lowest inflation risk because of the time frame. We know we'll get paid back our money in 3 months, and we think we're going to be able to buy this with it. But what about in 10 years? You know you're going to get your money back, but you don't know what the hell you're going to be able to buy. That's the real risk. It's the inflation risk. And if these yields uninverted, then the historical, what they call normalization, because let's just think about it for a second. Like if I said, hey, Opti, I want to borrow, $1 million from you, and I want to borrow it for 3 months. Then you would say, okay, yeah, it's cool. You can borrow it for 5%. I think that's good. I trust you as a counterparty, and I know you're good for it. Let's do it. But what if I said, hey, Opti, I want to borrow for 10 years? Well, would you raise the interest rate or would you lower the interest rate? Obviously, you would raise the interest rate because there's more risk. So in a normal yield curve, the shorter the duration of the loan, the lower the interest rate. The longer the duration of the loan, the higher the interest rate. That's the natural way that these things work. It's called a term premium. Well, what happens when the yield curve becomes inverted and the short-term rates are higher than the long-term rates? There's really only one way to justify this. And the justification by the marketplace is this: we think that there's going to be a huge deflationary event. And because there's going to be a huge deflationary event, the Federal Reserve is going to have to lower the interest rate. And when they lower the interest rate, not only will I get a capital gain, but and these guys are the real doomsdayers, right? I'm looking toward to a Bitcoin future, to a truth money future. These guys want a depression. They want a recession because they want prices to crash so that they can turn their bonds and lock in that capital gain and then buy real world assets. So they're kind of hoping against everybody just so that they can get a little bit more. But the reality of it is that the only reason, if you're managing a large amount of money and you're trying to protect that money, the only reason that you would buy a 10-year note for less than a 3-month bill, right? Because you could just get the 5.5 at 3 months. Who the hell is buying 10 years at less than 5.5 when you can get 3 months at 5.5? Because the 3-month you can roll. So the 10 years is saying, I want to lock this rate in because I think the rates are going down. What does that mean? When you simplify this down to the core of it, what it truly means is the market believes the Federal Reserve's 2% inflation target.